Did you know that Tesla is on track to become the world's best-selling car? How did they achieve this? And what does it mean for you as an investor or potential investor? Tesla tripled their vehicle sales in just 3 years. I'm Marcus, and welcome to this comprehensive analysis of Tesla's current market position and future prospects. In this video, we'll delve into the company's impressive growth, its challenges, and the strategies you can employ as an investor. Whether you're already invested in Tesla or considering it, this video will provide you with valuable insights and a deeper understanding of this game-changing company. If you find this video helpful, don't forget to give it a like, subscribe to our channel for more insightful content, and share your thoughts in the comments section. We'd love to hear your projections for Tesla. We start with great news for Tesla investors. Over the weekend, Tesla exceeded the expectations by delivering 466,000 vehicles, surpassing expectations, and producing 480,000 vehicles, also above expectations. This is a recurring theme with Tesla, always delivering more than expected. In this video, we will cover two things that are important to me as a Tesla investor, and I suppose they are also important to you as a Tesla investor. First, what does all this mean for Tesla investors in the future? And second, what is my personal strategy with my Tesla shares given what just happened? Tesla has once again shown that they are really good at execution. Yes, I know that Elon sometimes promises too much and does not always deliver on time. But think about it this way. Would you rather Elon give you something half done just to meet a deadline? No, he wants it to be perfect. And yes, the Cybertruck has been delayed, the Semi is moving slow, but he's not going to put out something that's not good enough in his eyes. And I respect that. The same people who were telling you that Tesla would never give you 500,000 vehicles in a single year in 2018 are now telling you that Tesla will never surpass VW and Toyota, which is kind of a joke. But let's talk about that. Tesla delivered more cars in the first 2 quarters of this year than in the full 3 quarters of last year. They are currently on track to deliver 1.8 million vehicles this year. Now, obviously, nothing is certain in life except death and taxes. And there is no certainty of anything, but they are on the right track. Their pace is absolutely phenomenal. But wait a second, there are obstacles and challenges that we have to talk about in this video. I'm not here to inflate the price of Tesla's shares or to ignore the things that raise doubts. You have to be in the position to be able to doubt, to be skeptical about your favorite company. And Tesla is definitely one of my 2 favorite companies. I'm not going to lie about that. But here's the problem. What we got last weekend is only half the picture. That half is beautiful, don't get me wrong, absolutely brilliant deliveries. But you have to remember that Tesla lowered prices to get to that point. When you lower prices, the amount of demand goes up. It's basic economics. So when Tesla lowered prices, and we got that increase in deliveries, that's great. But now we have to wait and see in the upcoming quarterly reports what is the impact on Tesla's profitability. Because if this profitability erodes and drops much more than it was before, this increase in demand and sales will not be as significant as it could have been if the margins had remained high. What I'm trying to explain to you here is that margins matter. So the question here is, how do these deliveries look in the context of Tesla's finances? How much money did Tesla make with all these extra cars they sold? I have a number in my hand, so Tesla, if they can deliver a 20% gross margin for automotive gross margin less credits, that's fantastic. I have a feeling we're going to be very happy with the results, but bad results could come out. Who knows? We won't know until we see the quarterly reports. I'm not going to pretend here as if I have all the keys to the future because I don't. I don't have a crystal ball. I've heard all this chatter about Tesla never going to outsell Toyota and VW and all that garbage. Look, Tesla is already on track to become the best-selling car in the world. Right now, the Model Y is almost at 800,000 vehicles per year. The Corolla is at 1.2 million per year. At the pace Tesla is growing, that pace is phenomenal. Let me remind you, Tesla sold 500,000 vehicles in a year just 3 years ago. In those 3 years, they went from 500,000 vehicles to currently 1.65 million vehicle sales in the last 12 months. So Tesla tripled their vehicle sales in 3 years. Toyota, I can assure you they have not tripled their vehicle sales. So if the Model Y is currently at 800,000 and the Corolla is at 1.2 million, The Model Y is going to surpass the Corolla in the next 2 years. It's almost certain, again. Be careful with that word, certainty, but you know what I mean here. So if Tesla surpasses the Corolla, that will be just the first step in an inevitable process in which Tesla will become the largest car manufacturer in the world. So, do you buy now like crazy? Are you going to jump on the train and start buying Tesla shares as if there were no more? Wait a second. There are still big hurdles to surpass Toyota. It still needs to go from 1.8 million cars a year to 10 million cars a year. So it needs to multiply its production by 5. And although the only thing preventing Tesla from becoming the largest car manufacturer in the world is its ability to produce those 10 million cars, that's true. That capacity is not simple. You can't just say, here you have 5 million more cars. Here's my factory. It doesn't work like that. It takes years. So, be patient. It's not going to happen that fast. Now, as a prudent and objective Tesla bull, here's how you should look at Tesla. The first thing you should look at are the fundamentals. Now, at Tesla's current price level, which currently ranges between $270 and $280 per share, we have to take a look at the value that is here for investors without all the hype. First, you'll see that Tesla is trading at 70 times earnings. That's not cheap by any concept. But it's also not extremely expensive like some other companies that are in the AI hype. It's far from that. At 70 times earnings, given the fact that we have $22 billion in cash, virtually no debt, a 14% operating margin, this is a very, very interesting stock. Now, again, you have to pay for quality, and 70 times earnings is not cheap, but I would call it in the range of reason, on the expensive side. How expensive? Well, if we give Tesla 50% growth for the next 5 years, we get a value of $244 per share, which is a little expensive given the current price of $280 per share. So Tesla is currently trading above the range of 50% growth for the next 5 years, every year. That's a lot to ask of Tesla. Now, they can get it, but it's not going to be easy. And buying now at these prices is assuming a lot of this risk. You would be assuming a lot of that risk. But of course, you can run your own model and find out what the price is for you. But the only thing I can tell you is that, no matter what model you run, you will never come to the conclusion that Tesla is currently very, very cheap. It is currently trading on the slightly more expensive side. It's just a fact. Now, whether you think it can reach $2,500 per share or not, which I think is possible currently, on the existing fundamentals of this company, it's not trading cheap. And no matter how much you love this company, it's just a fact. So, if it's not trading cheap, but you still believe it's an incredibly good generational company that you want to own, what do you do in this situation? Do you really buy it at $280? Well, yes and no, and I'll explain. We have a method of buying great companies that are a bit on the expensive side with the lower cost base than most. Look at Tesla. Its 52-week high is currently $317 per share. If you calculate 10% below that, that point is $280. So you know that $280 is that line 10% below the current 52-week high. Now, if you have already decided for yourself that you are going to dollar cost average into Tesla by putting a fixed amount of dollars each week into the stock, whenever the stock is below that threshold amount, the $280, then you are putting double the amount you have allocated. And when the stock price jumps above that 10% threshold, in our case, the $280 line for Tesla, at that point you go back and start investing your regular fixed amount. A simple example, if I invest $100 every week in Tesla, whenever the stock price is 10% below the 52-week high or less, I'm going to double and I'm going to put $200. But the moment the stock price goes above $280, above the threshold line, that 10% of the 52-week high and enters that range, I go back to $100. No more $200 per week. Now I'm at $100 per week. And I'll stay at $100 per week as long as the stock price stays above that threshold line. And in that way, I'm creating a weighted average of my cost base. So when I look at it 3 years later, I'm much closer to the bottom than to the top. Very, very simple, very effective. The system is not complicated. I just showed you that. But the hard part of the system is not the dollar cost averaging system. The hard part is choosing the right companies. If you dollar cost average into a company that does not perform well, you're in trouble, my friend. That's all I'm saying. So, in my opinion, the hardest part of the system is not the discipline. It's not the dollar cost averaging. It's choosing the right company to dollar cost average into over 3 years. Because if you make the right decision, great. If you make the wrong decision, you're in trouble. And that's it for today, friends. I hope you enjoyed the video. If so, don't forget to give it a like and subscribe to the channel. I would also love to hear your thoughts in the comment section. Until next time.